Something has been shifting quietly in the background of this market, and almost nobody has been talking about it the right way. For close to 5 years, Bitcoin and gold have moved together in a pattern that traders, analysts, and everyday investors got used to watching. That pattern is now breaking apart in front of us right now in the second half of 2026. And the fascinating part isn't just that Bitcoin is behaving differently than gold. It's what that shift might actually be telling us about where all of this is heading next. Because here's the real question underneath the headline. If Bitcoin is stepping out of gold's shadow and starting to write its own script, does that open the door to numbers that sound almost absurd today? Numbers like $500,000 per coin? Stay with me here, because I'm not going to feed you a hype reel. I'm going to walk you through the actual mechanics behind this idea piece by piece, so you can decide for yourself whether it holds up. Quick disclaimer before we go any further. This video is for educational and informational purposes only. Nothing here is financial advice, and nothing here is a guarantee of future prices. Bitcoin, gold, and every asset we mentioned today carry real risk, and you should always do your own research or speak with a licensed advisor before making decisions with your money. Now, let's get into it. And before we go one step deeper, there's a problem hiding inside the $500,000 argument. A big one. If you skip past it, the whole thesis falls apart in your hands. I'm going to show you exactly where that crack is, but not yet. First, we need to set the stage properly. Quick question while we're here. What's the weather like where you're watching this from? Drop it in the comments. I read every single one, and it genuinely helps me know where this channel is reaching. Also, tell me honestly, are you watching this on your lunch break, right before bed, or while you're supposed to be doing something else entirely? I want to know who's actually in this room with me today. Let's talk about why this comparison even exists in the first place. Bitcoin has spent years being measured against gold. Both get called alternative assets. Both get discussed as hedges against currency weakness, against inflation, against the kind of monetary uncertainty that makes people nervous about holding pure cash. Both tend to react when real interest rates move, when central banks signal something new, or when geopolitical tension spikes. But here's something people forget constantly, and it's costing them clarity. Correlation is not causation. Two things moving together for a while doesn't mean they share a destiny. And when that correlation breaks, it does not automatically mean the asset that broke away is now headed straight up. That's a trap, a comfortable, exciting trap, but a trap nonetheless. So no, this isn't going to be another Bitcoin to the moon video dressed up in nicer language. This is an investigation into what actually changed, why it changed, and what would genuinely have to happen for a number like $500,000 to become something other than a fantasy. If that sounds like the kind of channel you want in your corner, one that explains the mechanics instead of just shouting predictions, go ahead and subscribe to the Wealth Continuum right now. It costs nothing, and it means you won't miss the next piece of this puzzle. Let's rewind and look at what actually connected these two assets for so long. Picture the chart in your head. Bitcoin on one line, gold on the other, both reacting to similar macro pressures across roughly the past 5 years. Periods of monetary debasement worry. Periods where real yields dropped and investors went hunting for something that couldn't simply be printed into oblivion. Periods of currency stress, geopolitical shock, and a general appetite for stores of value outside the traditional financial system. Investors lumped Bitcoin and gold together because, on the surface, they scratch a similar itch. But here's the distinction that actually matters, and it's one people gloss over constantly. Gold is an established monetary reserve asset. It has thousands of years of history, central bank vaults full of it, and a level of trust baked into human civilization that nothing digital can claim yet. Bitcoin is something else entirely. It's a digitally native, mathematically scarce asset that carries monetary characteristics, but it behaves, at least for now, much more like a risk asset than a safe haven. That distinction is going to matter a lot as we go further, so keep it in the back of your mind. This is where Bitcoin's story starts pulling away from gold's story, and honestly, that's where things get interesting. Here's what a lot of commentary online gets wrong, and I want to correct it clearly. Correlations break for all kinds of reasons that have nothing to do with one asset becoming better than another. Different investor bases buy each asset. Different liquidity sensitivities drive each price. Different volatility profiles scare off different types of capital. Exchange-traded fund flows move on different schedules. Institutional desks position differently depending on interest rate expectations. None of that is inherently bullish or bearish on its own. Think about it this way. Gold tends to attract defensive capital the moment uncertainty spikes. It's the asset people run to when they're scared. Bitcoin, at least historically, has often behaved more like a liquidity-sensitive risk asset, something that thrives when money is cheap and easy and struggles when it isn't, So two assets can share a long-term narrative about scarcity and monetary independence, while behaving in completely opposite ways over shorter stretches of time. That's not a contradiction. That's just how markets work. But here's the part that could matter far more than the correlation breaking at all. Who is actually buying Bitcoin right now, and what kind of capital are they bringing with them into this market? That question is the hinge this entire video swings on. Stay with me, because the next part changes how you should be thinking about all of this. This is where the story stops being about a chart pattern and starts being about actual money moving through the system. Bitcoin's investor base has evolved dramatically. It started with retail speculation. Individuals buying on exchanges, often driven by excitement more than analysis. Then came professional trading desks. Then spot exchange-traded funds arrived and gave traditional finance a regulated doorway in. And now we're watching institutional allocation become a real, ongoing category of demand rather than a one-off headline. As of this week, spot Bitcoin exchange-traded funds in the United States have pulled in roughly $242 million in a single day, extending a 9-day streak of net inflows worth close to $3 billion. That is not retail excitement. That is structured, repeatable capital flow from investors who allocate methodically. Institutions typically don't buy Bitcoin because they think it will pop tomorrow. They buy it because it offers portfolio diversification, a form of monetary exposure outside sovereign currencies, an asymmetric risk-reward profile, and digital scarcity that cannot be replicated by policy decisions. Now compare that to gold's position. Gold has decades, really centuries, of institutional trust already built in. Central banks hold it as a reserve asset without a second thought. Bitcoin is trying to build that same level of legitimacy in a fraction of the time. And in some ways, it's succeeding faster than most people expected even 2 or 3 years ago. And this is exactly where the $500,000 argument starts becoming mathematically interesting, rather than just a headline built to get clicks. Comment below if you've noticed institutions talking about Bitcoin differently than they did a few years ago. I want to hear what you've seen, because the sentiment shift has been noticeable even outside of financial media. Let's be precise here, because vague numbers are how people get misled. As of today, August the 28th, 2026, Bitcoin is trading in the neighborhood of $80,000, having climbed back above that level on the back of strong exchange-traded fund demand and broader risk appetite in the market. Gold, meanwhile, is trading around $4,600 per troy ounce, sitting near its highest levels in roughly 3 months as investors hedge against dollar debasement concerns and shifting Federal Reserve expectations. Bitcoin's price is ultimately a function of one simple equation: market capitalization divided by circulating supply. There are just over 20 million Bitcoin in circulation right now, out of a hard cap of 21 million that will ever exist. That scarcity is the entire foundation of the monetary argument. If Bitcoin eventually captured a meaningful slice of the capital currently parked in gold and other traditional stores of value, its market capitalization could expand dramatically, and the price per coin would follow. But here's the catch, and it's an important one. Bitcoin does not need to fully replace gold for this to happen. It just needs to capture a growing share of a much larger pool of global monetary and investment capital. And that pool is genuinely enormous. Gold alone represents trillions of dollars in above-ground reserves held by central banks, institutions, and private investors around the world. Let's break this into 3 rough scenarios so this stops feeling abstract. Scenario 1 involves a small migration of capital, a modest, gradual shift where Bitcoin picks up incremental allocation from portfolios that are already diversifying. This scenario supports meaningful price appreciation, but nowhere near the $500,000 mark. Scenario 2 involves meaningful institutional allocation, pension funds, sovereign wealth funds, and asset managers treating Bitcoin as a standard component of a diversified portfolio, the way many already treat gold. This scenario could support substantially higher valuations than where we sit today. Scenario 3 involves Bitcoin becoming a recognized global monetary asset at a scale approaching gold's current role. This is the scenario where a number like $500,000 starts to become mathematically plausible, not because someone tweeted it, but because the underlying capital base supporting that price would genuinely need to exist. $500,000 belongs to scenario 3. It is not a simple technical breakout story, and anyone telling you otherwise is skipping the actual math to sell you excitement instead. Here's something Bitcoin bulls get wrong constantly, and I want to be very clear about it. Bitcoin does not need gold to fail for this thesis to work. These two assets can absolutely coexist, and honestly, that coexistence is the more realistic outcome. Gold can remain exactly what it has always been: a central bank reserve asset, a physical store of value, a crisis hedge, and a form of institutional insurance that has survived every currency collapse in recorded history. Bitcoin, meanwhile, can develop into something genuinely new: a digital monetary asset, a globally transferable scarce resource, an alternative reserve holding, and a form of digitally native collateral that didn't exist as an option before roughly 2009. Together, these two assets create a larger total monetary ecosystem, rather than a winner-take-all cage match. That reframing matters enormously because most of the loudest arguments online frame this as Bitcoin versus gold, when the more accurate framing might be Bitcoin alongside gold. But if Bitcoin genuinely doesn't need to replace gold to succeed, what actually has to happen before a number like $500,000 becomes remotely plausible? That's exactly where we're headed next, and this is where it gets really concerning for anyone expecting a shortcut. Here's the framework, laid out plainly, condition by condition. Condition number 1 is institutional demand. More pension funds, endowments, insurance companies, and asset managers need to treat Bitcoin as a standard portfolio allocation, rather than a speculative curiosity. We're seeing early signs of this already. Firms like Schwab expanding their crypto offerings and steady exchange-traded fund inflows week after week. But this needs to become the norm across the entire financial industry, not just a handful of forward-leaning firms. Condition number 2 is global liquidity. Bitcoin has historically thrived when financial conditions loosen, when interest rates fall, when credit becomes easier to access, and when investors feel comfortable taking on risk. Right now, markets are watching the Federal Reserve closely, with September rate decisions hanging in the balance, and inflation data still running hotter than the central bank would like. Condition number 3 is monetary credibility. The stronger the demand becomes for scarce non-sovereign assets, assets that no government can simply print more of, the stronger Bitcoin's long-term monetary thesis becomes. Interestingly, gold has been benefiting from exactly this kind of demand recently, with central banks, including China's, adding to their reserves at a pace not seen in years. If that same appetite eventually flows toward Bitcoin, this condition strengthens considerably. Condition number 4 is infrastructure. Custody solutions, regulated exchange-traded funds, clear settlement systems, and sensible regulation all need to keep maturing. This is arguably the condition that has advanced the fastest over the past 2 years, and it's a big part of why institutional participation has become possible at all. If these 4 forces begin reinforcing each other simultaneously, Bitcoin stops looking like just another volatile technology-adjacent asset and starts looking like something closer to a genuine monetary contender. But if even 1 or 2 of these conditions stall out, the $500,000 conversation becomes a lot harder to justify. You need to understand this before we go any further, because the next section is where a lot of bullish arguments quietly fall apart. Let's shift gears and talk macro for a moment, because none of this happens in a vacuum. Federal Reserve policy, interest rates, real yields, dollar liquidity, treasury issuance, and overall credit conditions all shape how much capital is available to chase assets like Bitcoin. Right now, the market is watching Federal Reserve Chair Kevin Warsh's remarks at the Jackson Hole Symposium closely, hoping for hints about the September policy decision. As of this week, markets are pricing in roughly a 38% chance of a rate move by September, with the probability climbing well above 70% by December. Here's the key idea, and it's one worth repeating because it protects you from getting swept up in hype. Bitcoin can have an extraordinary long-term monetary narrative and still fall sharply in the short term the moment global liquidity tightens. Those two things are not contradictory. They coexist constantly. So here's a question worth sitting with for a second. If Bitcoin is supposedly becoming digital gold, why does it still behave like a risk asset during liquidity crunches? The honest answer is that Bitcoin hasn't fully completed that transition yet. It's somewhere in between, no longer purely speculative, but not yet fully established as a defensive monetary asset either. That in-between status is precisely why the story is still unfolding in real time, rather than already decided. Let's lay this out honestly, side by side, because credibility matters more than excitement. Gold carries thousands of years of monetary history behind it. Bitcoin, even after roughly 17 years of existence, is still a young monetary asset by comparison. Gold sits inside central bank reserves around the world as a matter of routine. Bitcoin's presence in official reserves remains limited, though a few nations have begun experimenting with holding it. Gold's volatility is comparatively low. Bitcoin remains extremely volatile, capable of double-digit percentage swings within days. Gold is physical, tangible, something you can literally hold in your hand. Bitcoin is entirely digital. Gold's market infrastructure is deeply established across nearly every financial institution on Earth. Bitcoin's infrastructure is still rapidly developing. Even if it's advancing quickly, gold behaves primarily as a crisis asset. Bitcoin behaves as a hybrid between a risk asset and an emerging monetary asset. But here's the twist worth sitting with. Bitcoin doesn't need to become gold. In fact, its biggest opportunity might be becoming something gold simply cannot be. Stay with me, because this next idea is the real intellectual core of this entire video. Instead of asking whether Bitcoin will replace gold, let's ask a more interesting question. Can Bitcoin create an entirely new category of monetary asset that didn't exist before? Gold's scarcity comes from geology. There's only so much of it in the Earth's crust, and mining it takes real effort. Bitcoin's scarcity comes from mathematics, encoded permanently into its protocol, with a supply cap that cannot be altered by any government, company, or individual. Gold is difficult to move across borders in large quantities. Bitcoin can theoretically move across the entire planet through digital infrastructure in minutes, regardless of borders or capital controls. Gold requires physical vaults, security, and custody arrangements that have existed for centuries. Bitcoin requires digital custody, a completely different set of solutions that are still being refined and improved. None of this guarantees Bitcoin wins anything, but it does explain why serious institutions are increasingly treating it as something categorically different from just another speculative technology stock. It's being evaluated on its own terms now, not simply as digital gold copying an older asset's homework. Now let's turn the microscope on our own argument, because that's the only honest way to do this. Regulation remains a genuine wildcard. Government policy can expand or restrict access to Bitcoin overnight, and different countries are taking wildly different approaches even today. Liquidity tightening could suppress speculative and risk-seeking capital for extended periods, especially if the Federal Reserve holds rates higher for longer than markets currently expect. Volatility itself limits institutional allocation. Many large funds have mandates that simply prohibit holding assets with Bitcoin's kind of drawdown risk, no matter how compelling the long-term story sounds. Competition from other digital assets or emerging monetary technologies could siphon capital that might otherwise have flowed into Bitcoin specifically. Narrative failure is perhaps the most underrated risk of all. If investors collectively stop viewing Bitcoin as a monetary asset and start treating it purely as a speculative trading vehicle again, the entire valuation framework built around scarcity and institutional adoption simply falls apart. And here's an even bigger problem worth sitting with, because it's the part most bullish content conveniently skips. Bitcoin can be completely right about scarcity, completely right about digital monetary theory, and still go nowhere for years if the capital simply doesn't show up on schedule. Being right and being rewarded are not the same thing in financial markets, and history is full of correct ideas that took a decade longer to pay off than anyone expected. This is where it gets really concerning for anyone treating $500,000 as some kind of inevitability. It isn't inevitable, it's conditional, and every single condition has to actually materialize. Let's bring this back to where we started, the 5-year trend breaking apart. Don't obsess over a single correlation reading on a single day. That's noise, not signal. Instead, watch a handful of things consistently over time. Bitcoin's relationship with gold, Bitcoin's relationship with global liquidity conditions, exchange-traded fund flow data, institutional positioning reports, real yield movements, dollar strength, and overall risk appetite across markets. The real question to keep asking yourself week after week is this. Is Bitcoin increasingly trading according to its own independent monetary narrative, or is it still primarily being pushed around by global liquidity conditions the same way it always has been? That question, more than any price target, is the actual test of whether this thesis is playing out in reality. How would you answer that question right now, based on what you've personally observed? Genuinely curious? Drop your take in the comments, because I read through them and it shapes what I cover next. So, is $500,000 next? Nobody can responsibly tell you that with confidence, and anyone who does is selling you certainty that simply doesn't exist in financial markets. One broken correlation, however interesting, does not hand us a price target. But here's the thing, that's actually not the important conclusion to take away from any of this. The important conclusion is that Bitcoin's relationship with traditional monetary assets appears to be genuinely evolving in real time in front of us. If Bitcoin gradually attracts a larger and larger share of global capital over the coming years, the long-term valuation framework changes substantially, and numbers that sound unreasonable today start sounding a lot more grounded. But if liquidity conditions deteriorate and institutional demand stalls out, the $500,000 thesis becomes significantly harder to justify, no matter how compelling the scarcity argument sounds on paper. Let's go back to where we opened this whole conversation. 5 years ago, comparing Bitcoin to gold was mostly about whether Bitcoin could behave like a digital version of something investors already understood and trusted. Today, in the latter half of 2026, the far more interesting question has shifted entirely. It's no longer about imitation. It's about whether Bitcoin is becoming its own distinct monetary asset class, standing on its own foundation rather than borrowing gold's. The broken correlation we opened with isn't the destination of this story. It's the signal. The flashing light telling us that investors, institutions, and analysts alike may need an entirely new framework for understanding what Bitcoin actually is, rather than continuing to force it into gold's old shape. If Bitcoin turns out to simply be another liquidity-sensitive risk asset dressed up in scarcity language, $500,000 remains a very distant, very different proposition. But if Bitcoin continues moving toward becoming a globally recognized scarce monetary asset, while institutional access keeps expanding and capital keeps migrating steadily into this ecosystem, then the entire valuation conversation becomes something much bigger than a simple comparison against gold's price per ounce. The real question isn't whether Bitcoin will become gold. The real question is whether the world is quietly building an entirely new category of monetary asset, and whether we're watching that transition unfold in real time, right here, in this exact moment of the market's history. Hit like if this actually made you rethink how you look at Bitcoin's relationship with gold. Subscribe if you want more breakdowns like this one, built on mechanics and actual numbers rather than hype and empty predictions. And if you know someone who keeps repeating price targets without understanding the reasoning behind them, share this video with them. It might change how they think about the whole conversation. One last question before you go. If you had to bet on which of the 4 conditions we covered today is closest to being met right now, which one would you pick? Tell me in the comments. I genuinely want to see where this community lands on that. This has been the Wealth Continuum. I'll see you in the next one.